I did see U2 on that tour, and he was I was in Norman, Oklahoma, and he during that concert went up and down every aisle of the stadium carrying a giant white flag, and so I was like 3 feet away from him.
That was the Joshua Tree tour.
What's the what?
The Joshua Tree tour. 87.
Joshua Tree. You're right.
Yeah, I worked on it. I was traveling around with them.
Really?
Yeah.
Holy shit! Did you come to the States for that?
I was just trying to remember. I was on the tour when, not on the tour, but at an event in DC when they had the stage that went out it went out into the audience, and so Bono would get out there, and it was just such a blast. But I think that would have been that sounds like 92 time frame. So I think that's after Joshua Tree, right? Or is that?
Yeah, Joshua Tree was 87, 88. Yeah.
Wait,
yeah.
Shaun, you got to back up and tell us this. Tell us why you were on tour. What were you doing, buddy?
I was doing as little as possible, and nothing that I'll admit on public air. But I worked for them on the Joshua Tree tour. Yeah, it was an experience.
That's so fucking cool.
Yeah.
I mean, do you know these guys, or you just had a gig with it?
Oh no! I was going through college, and I got a summer job working for them on the tour, and to be honest, I very nearly kind of quit college and just kept going. I'd be long dead if I did that.
I'm sure, but what a great life experience.
I did quite a few. I worked with Jackson, fucking hell, Prince or whatever he was called back in the day. My favorite was Frank Sinatra. I did a tour with him.
Holy shit!
Amazing.
I mean,
that's a real rock star.
Were you like lugging equipment or doing electronics? Or
I was responsible, and it's a very big word, responsible, for what I was doing, but basically looking after everything to do with the stadium rather than the stage itself. Okay. So you typically do every second gig because they've got 2 or 3 things on the road, but that's a story for a pint.
Holy shit, dude. That's amazing. Oh, I definitely want to hear some of those stories. I got to get over there to see you.
Always welcome, man. Right now, I need help digging a road into a mine. Watching your recent gardening stuff, I'm going, there's a man who knows how to get a road into the middle of nowhere.
I am pretty handy. But yeah, there you go. All right, guys. Well, I don't have any big news for today, and I know, Shaun, you have some things you're ready to chat about. So, Chuck said Shaun the Fluffer. Shaun is no longer invited to Ireland. Chuck is no longer invited to Ireland.
Chuck's always welcome.
Nick Nibble says Octoon Baby is still such a strong album. Nice recovery from Rattle and Hum. Yeah, I agree.
I gave up on them after 87. I just let's not go down that road. I mean, I think Bonzo is a complete idiot, but there you go.
Well, there you go. Ola Biomex, welcome, man. Glad to see you here. Thanks for joining us. Feel free to add your comments during the show. We'd love to hear from you. So, Shaun, you had some things you wanted to talk about because we are getting the flow of money out of crypto wrong. And so I'd love for you to expand on that. I know that's one of the things you wanted to talk about today. So
let's go there. And again, being the sensitive soul that I am, very easily hurt, emotionally damaged, all these people calling me a nasty maxi. I'm joking. That I thought, I'm going to go through this one last time because I'm pretty sure that I'm not articulating this right, but
or we're just not paying enough attention, and we're not.
I guess nobody should pay attention to me. That's kind of accepted.
No, that's why we have you here.
So, I've got a few things that we would look at internally, and I'm just going to roll through them quickly, and then going to be depressing about what I think the market's going to do again, and then going to say, look, there's lots of ways to make money, and here's another one. Beyond market making, which is
it's insane. I just had a call with Keith, and we were talking about kind of the depressing stuff, and then we were talking about but what do we do? And here you go, you're providing the answers. That was like 30 minutes ago, dude.
Yeah, that's my point. Look, you can there are ways to extract money from markets, whatever the conditions. And even if you want to be all in long, your 120 favorite shitcoins or whatever, or you want to be all in short the market because you think it's all going to zero or whatever, that doesn't mean that you shouldn't equally just be, as I was saying when we discussed the market making stuff, just there's so many easy ways to extract value. And so maybe a lot of people have heard about the cash and carry or basis trade, which is a risk-free trade. The only risk you carry is counterparty risk. I'll go through it at the end because I didn't want to be my usual, we're all fucked. What are we even doing here anymore? Self.
That's quite all right. Listen, I got to tell you, I think there is incredible value in hearing that and having people understand that no matter what's happening right now and kind of overall what you're seeing in the market, that the conditions are not perfect for, they're not as good as you guys might think they are just because Bitcoin's up since January. So
yeah, I mean, Ryan Selskis is a 2-bit idiot, as I think has finally come around and he's been kind of publicly going, look, I don't think you guys understand how bad this is. Right. We could both be wrong, very good probability, but I'll just say to people, maybe we're right. And what I'm going to present today is not anything other than hard data. Okay, right. So this is not subject to, everything's subject to an opinion, but this is simply a statement of fact. And what I was going to start with, this is global liquidity. Macro, everything. Forget crypto, forget everything. Yeah. And okay. Credit here to 42 Macro, Darius Dale, who produced this data. Really worth the sign up if you're not doing it. But
wait, who is that again?
42 Macro.
Okay.
Is the company. They provide to people, to retail, what I would call hedge fund level, institutional level market analysis. And again, a lot of this analysis may be stuff that people don't like, don't want to hear, but sometimes when there's a rattlesnake in the path, it's best not to stand on it. Hello guys, can you hear me?
Yeah, I can hear you.
I'm sitting here laughing and commenting, and I'm muted.
Okay, sorry. So this simple graph is just because whatever way we view it, we're just a subset of global regimes. One day we hope to break free, but fundamentally we price everything in dollars. That's the other side of the trade for everything. So we need to understand what's happening with global liquidity. I'm going to run through this real quickly. So the top blue line here is central bank balance sheets. So this is all central banks, global central banks, not just looking at the Fed. You've got global narrow money supply, M1. We would call it for the US, which again, people go, M1 is this, but M1 and M2 track in terms of directionally. So just showing M1 is fine. And then you've got global FX reserves. Beneath these, for each of them, again, blue, red, and black, you've got momentum. So the most interesting one is global liquidity, narrow money supply, about $52 trillion of narrow money supply floating around the world. It's a big fucking number. And what you can see is that normally narrow money supply is increasing. You can see that, after COVID, global narrow money supply, went batshit crazy. You can see that we had the effects of QE, but you'll also notice here at the end of last year, early this year, we had a bip up in global narrow money supply, which correlates strongly with the little run up we did in risk assets. So again, this demonstrates very clearly the impact of the amount of money in the globe. So what you can see now is that we're back to a QE regime, as in global narrow money supply, that's the supply of all money in the world denominated in dollars, is decreasing. That's not good. So before we even look at crypto, we can say that just the amount of money in the world is decreasing. And again, you can go through M2, you can go through, the central bank balance sheets and blah, 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 blah. But hard data, difficult. You can't argue with it. It's just fact. Yeah. Okay. So we have an overall decrease in global money supply. If we look then more specifically, and again, just something I wanted to hit on, this is global VC deals. Again, not crypto. This is VC deals into everything. Yeah. Okay. So whether that's my new, toothbrush venture or some new BRC20 token or whatever, everything's included. So again, not unsurprisingly, as there's more money in the world, there's more venture capital in the world, and it's tailing off. No, it's not horrendous. Yeah, it's just going back to
and I think I think we're going to see an anomaly in this data in the next quarter, purely from the pile in into AI, but it won't make a difference in what we're talking about.
Yeah, I mean the point really is that the availability of money for risk is strongly tied to global liquidity.
Sure,
okay,
makes sense.
So again, money needs to find a home. The more money there is, the more money that's going to flow into risk. The less money there is, the less money that's going to flow into risk, or anything for that matter. But you can see that this chart and the narrow money is pretty well correlated. Yeah? So you got a big bump in this, and again, our last bull run was all fueled by this. Crypto being the high risk end of risk. Okay, so even risk. I mean, VCs are in the risk business. Yeah, I mean they're investing in things is a lot more responsive to these kind of liquidity changes. So again, while there will always be VC deals going on, there's always somebody who is going to be investing in some project. Okay. It's also really important what the trend is. Yeah, how much, because what this reflects is an institutional appetite for risk. So if we just take the data and we break it down to VC money that's prepared to go into the risk end of risk, i.e., crypto projects, we can see that while in some ways it's very similar, the decline is heavier, and we're at the point now where we're basically trending down for a long time with no sign of recovery. So again, this reduction in narrow money supply affects everything from VC deals, and it affects more aggressively the riskier end of the risk curve. Okay, so there are still deals being done. There will always be deals being done. But if we are to be bullish on the market, we want to see this trend, of deal flow start to tick up. Okay, right. Because what we know, okay, from history is that it ticks up prior to a bull run. Okay, VCs love crypto. Okay. They really love crypto, and they'll love it more than AI. And let me explain why. And I know that Joe can comment on this and maybe disagree, but the thing about a VC is that if I go into invest in Shaun's new toothbrush company, okay, I'm getting equity. Okay, in order to get my value out, I need some kind of a trade deal. I need to sell this on to Brad's toothbrush company. He can absorb me, and then I can get some exit. Or I need to IPO it. IPO market is basically dead. What's great about crypto for VCs is that effectively they can go from investment to market, from day zero up to some form of a lock-in. So they can begin to get their money out very fast. And I'm not sure that's actually healthy for the space, but it is what it is. Yeah.
Right. Well, look, I mean, that's been a lot of what happened this time around was VCs dumping on retail their tokens, and they started to get longer and longer lockups. But the typical VC is expecting not to see anything on an investment for at least 5 years, and usually more like 10. And so when you can pile money into something that'll return money in 3 months, 6 months, 9 months, 12, whatever, 2 years, you're much more likely to do that. You're absolutely right.
But he's also right, though, that in the token space, they aren't locking up for 5, 10 years, that they are dumping in a matter of weeks.
That's my point. They're normal VC
and in traditional normal VC, you are buying the equity and it is locked up and you can't sell it until there's an M&A event or some kind of strategic transaction. So, the VCs aren't really under control in this space, I guess is a good way to put it, where they are in TradFi.
I would also suggest that by and large, they may be treating this as an ATM. And that they might, when you're locked into some investment for 5 to 10 years, you're going to, human nature, you're going to be fairly diligent about what you put your money into. When you have the ability to express a return and dump it directly into retail, remember, you're paying cents on the dollar. It's more likely that your risk tolerance goes through the roof. And we saw that in things like FTX already. We're just going like, this is just an ATM. We just keep sticking our card in and taking cash out.
Well, and it proves your point even further then. If we're seeing a decline in deals and it's their ATM and it's their way to make money or offset what they're seeing in their regular equity deals, and they're still not putting it in here, then it obviously makes your point that there's less money around to be doing anything with, and that the money is leaving, right? So I think that's a really valid point.
Well, if you think about it this way, that VC money that's put into the space, is effectively dissipating away via the burn rate. So if I'm a VC and I stick $200 million into a project, obviously there's a burn rate, so that money is dissipating, and in order to keep the show on the road, we need to see deal flow coming in. But my point is more fundamental, and I'm going to go through some more slides, is that every aspect of money flow that you would like to see in this space for a bull market is doing exactly the opposite of a bull narrative.
Right.
And I'm starting with simply with the VC side. So again, less money coming in, money still coming in, deals still being done. There always will be. There's always somebody. And again, that's mirroring what's happening in the wider VC world, but because of different dynamics, i.e. we're at the higher, we're at the outer edges of the risk curve, but also because of the amount of time these guys need to lock up their money in this space, it's more acute. That's all I'm saying. And look, the data don't lie.
Well, look, if you look at the chart, Shaun, and I'm just going to extrapolate that global VC chart to say crypto in general, because of the fact that the VCs, even the TradeFi ones, are in it as well, trading. You look at both of those run-ups in funding, they were all after like BTC blow-off tops. All right, so look at the one back in fourth quarter 17 through 18, and look at all the funding there. And then look at like fourth quarter 20 through 21, and look at all the funding there. To me, that is analogous to like sitting at the poker table or the craps table, where you had a bunch of winnings, and you got this giant stack, and you're tipping cocktail waitresses $100 for drinks and things like that. It's not like it's just everybody FOMOing into stuff and betting on the wrong stuff at high valuations, and then they get crushed. And then they're sitting there where they are now, licking their wounds, trying not to get like deposits pulled and things like that, and trying to find the next deals. But they have to be much, much more patient now. And so all the new VCs get washed out. And there's a whole business model on just buying defunct new VCs. It's just everybody craters. And so they just kick back the big ones and don't say anything and wait for the other ones to fall apart and wait for the real plays to come that they think are the real ones. And that's like, the connected ones and things like that. So to me, I think that it all looks completely logical. And, everything you said makes sense for all those reasons too.
Yeah, and also again, I do think that we need to be, maybe slightly more critical or cynical, have a cynical view of VC in this space, because from investment to return is a really short cycle. Yeah, it's a really short cycle and really lucrative. Yeah, I mean, it was an ATM. Yeah, you got yourself into pre-public offering, your cents on the dollars, and you can start selling at the dollars, within 3 months.
Yeah, and once you saw what really got me excited early on in like the 17 time frame was, when I looked at what Pantera was doing with the ICOs. And, essentially what you had there was an IPO model, but without lockups. And so, we all know how that worked. It was private sales or pre-private or special private. There was like 2 or 3 rounds before it got to the public sale.
Yep.
And so institutional VCs were dumping in the round right before the public sale. So they were dumping just before retail. And of course, retail gets crushed then. And once I realized there were no lockups and everybody could just flip out of the play whenever they wanted because they were in tokens, not equity, I started thinking, oh, I see what's going to happen here, because you're not forced, because we've all been burned on, friends and IPO stuff that went to nothing before the lockup ended. Well, all of a sudden they saw like the fatted calf here where, there is no lockup. So now some protocols, as Brad pointed earlier, do negotiate that or try to negotiate it. But, if you don't have to do it or do the deal, why would you sign up for that? If you're not chasing a deal, why would you sign up for that? So,
I think at the end of the cycle,
right.
I think at the end of the cycle, a lot of projects said, you know what, we're going to have lockups. They're still shorter though than anything you're going to get on the equity side. Absolutely. So, look, I think this point is completely valid and it makes sense. And I'm really glad you kind of explained it that way, Shaun. Niblin said
also it would be helpful if they go to more equity based stuff than tokens.
Yeah.
Get the incentives aligned with the founders.
Or dividend models, all kinds of things. And interestingly enough, I had just before we got on the show, retweeted a tweet from Scott, one of the original contributing founders at Canto, talking about the fact that you don't need a token. And I've been saying that for months. If you're questioning whether you need a token, you don't need a token. If it's not part of your model, it's not part of what your functioning is. Build a business that's revenue based, right? Stop. Because the other thing I said is almost every founder I've ever interviewed, their lives go from building and planning and having a strategy and engaging with their community to managing liquidity every friggin' day. And they fucking hate it. So, look, I think the trend's going to reverse. I think it's going to change. I think there'll be differences in how this model happens, but I think the point is incredibly valid here that the money has left. So, well,
again, I don't think that's I don't know it hasn't left, dude. It's still, it's left from what Shaun's saying, but all the VCs that I talk to, and they're in the top, 20 of the top 50 list, they're all sitting on boatloads of money right now.
Oh, I'm not saying
they're not investing it.
Disappeared or gone somewhere. I just mean that they're not going to invest it.
Well, they will if it's the right deal. So what I want any entrepreneur listening is that don't get discouraged by this, because if you're young and you have ideas, you're the guys and gals that the VCs want, because they don't expect you to hit a home run on your first deal. They're looking for people that are their go-to managers for the next 40 years. So you might mess this deal up, but if you play the game right and you don't run away and you take it like a pro or whatever, you'll get in the next deal of theirs, because they bet on people.
Right.
They're more about people than tech or deal or anything else. So,
totally
don't be discouraged from applying to the big ones, Sequoias, NEAs, all those. Just get hazed, man, and learn from it.
Totally agree with all that. But I think kind of going back to what Shaun's saying is the lack of the fact that they're not doing as much now impacts the ability to invest and trade and earn money in the market when the money's not in playing, right? And I think that's part of the equation is that the money not coming in is impacting the overall picture for making money.
The point I make, look, what we've been through is just utter insanity. Yeah.
Right.
Okay.
Yeah.
And at some point, this market, if it's going to be real, has to rationalize. Yeah. I mean, we just have to get rid of the froth, and you know, a lot of the motivation for VC money, and you know, look, I've been involved in a few deals, or could have been involved in a few deals. I walk away from 99% of them because it's literally just an ATM. Yeah. Okay, it's straight out. The actual business doesn't matter. Yeah, it's just, you know, is there going to be liquidity in 3 months? Is this going to get a Binance listing where we can just go from 1 cent to $1 and say thank you? So, you know, what I would say to people who are trying to build in this space is that I actually think this is a good thing. Yeah, because if you're going to build something of value, okay, I don't think that necessarily mattered so much up to now. And I think it actually is going to matter, because I think the money is going to get more discerning.
Makes total sense. Makes total sense.
100.
Niblet says, I get it's the trend, not the value in terms of M1, but as debt, leverage, and Eurodollars play a larger role, M1 becomes less relevant. Even the trend of M1, does this amplify risk assets?
Well, I mean, you know, the point about M1, I mean, is primarily a result of fractional reserve banking, hence it includes debt. Yeah. I mean, you know, the creation of debt is the creation of money.
Sure.
I mean, that's literally how fractional reserve banking works. The simple point is that, you know, and again, you can overanalyze this, and I did already put these slides into the Telegram group, and I'm quite happy to go through any questions on them. My point here is simply to present the hard data. So things, you know, all of that money is levered. It's the global money supply. So I think the last time we discussed the US money supply, what is curious about it is that while the US was still QTing, there was actually a bump up in global narrow money supply, which coincides with the little run up that we had. That was actually coming out of China, by the way. There was some QE in China, and we'll get to the regional stuff now, because I know a lot of people are, you know, saying that, you know, Asia is going to lead us out of the bear market, and I'm going to go, yeah, I don't think so, and I'll show the data why.
Chuck says that lesser risk in DeFi due to easier liquidation / exit is a reason why the community needs to adjust downward expectations for returns. The risk is a lot lower versus traditional VC. Yeah, exactly. Okay.
And yeah, sorry.
Shizzy said it's a bear market. Obviously, money is not rushing in. VCs come in when number goes up.
Well, that's actually not strictly true. I mean, the VC, you know, again, we come to this concept of accumulation. The VC, you know, the ideal play for anybody here is to actually accumulate at the bottom, and that's what you tend to see with the smart money. But again, you know, we've got some data on that. Again, there's not many slides here. I know this is boring the tits off most people.
No, it's not boring.
No, it's awesome.
Don't say that.
Totally cool.
This is
totally cool, dude.
So again, you know, kind of global M1 narrow money, and again, I'll talk to Niblet's thing, but you know, money, the existence of money is effectively the existence of debt, is what I'll say. I mean, that's the definition of fractional reserve banking. One of the things that we discussed is fund holdings. So to be clear, what I mean by fund holdings here, this is publicly quoted companies that hold Bitcoin on their balance sheet. Okay, so this is because we always have this thing about, you know, our institutions are doing this, that, and the other, and you know, there's 1,000 different types of institutions, but if you look at balance sheet holdings, they're actually declining. Okay, so again, something that is not what you want to see it at the start of a bull market, or so on. And again, I'll come back to what I think. So again, you know, if we look at, you know, less VC money, balance sheet holdings are being sold. And again, remember, these are the you know, the what do they call them? The diamond hands or something. These are the diamond hands of the diamond hands. Well, not so much anymore. So again, something to consider. If we look at trading fund volume, so this would be institutional trading fund. I mean, look, it tells its own story. You can see what happens in a bull market. Yeah,
sure.
There's lots of institutional interest. And again, I need to be very clear. This is not that there's no interest. It's all about what does the interest look like in a bull market versus what does it look like in a bear market or at the bottom of a market. So, you know, I think it's fairly apparent that there's just no institutional. There's always institutional interest. There is zero significant institutional interest in this space at the moment in terms of trading. So again, I go from VC investments through to balance sheet holding, through to trading interest. Okay, all of which show, unfortunately, the same thing. And again, man, this is hard data. This is not, you know, I'm quite happy to provide all the sources of, you know, all of the slides. God, did I say slides like I'm doing a pitch deck here?
Just Shaun, what do you got? What are you working on?
Invest in me.
I said the pitch is short BTC.
Always been that long, BTC, dude. Come on.
Yeah, always not long. I know. Always not long. Before I get strung up over here.
Trading short.
Yeah, but just everybody here is permanently long, trading short.
No, I'm sick of presenting this. This is just the amount of. So again, you know, I'm going to sound like Jerome Powell, long and variable lag. So
what are we looking at?
This is the stable coin supply, which is, so this is all stable coins in issue. Yeah. Okay. So there's a couple of things there.
Blue is?
The blue is stable coins in issue, and the orange is just Bitcoin price. Yeah. I put Bitcoin price on here because what people don't understand is that it takes time. You know, this is Jerome Powell-esque, long and variable lags. Yeah. Okay. So, you know, you can see that when the bear market started, you know, billions of dollars were still flowing in. Yeah.
Yeah.
Okay. So, you know, this is not an immediate response thing. You know, this is not the, you know, if $10 billion leaves tomorrow, price is going to go down 10%. It's not the way this stuff works. Liquidity doesn't work that way. It takes time to have an effect. Okay. Right. However, okay, if the market is bottoming and if we're going to have a bull market anytime soon, you want to see this tick up. The other point I would have to say, this is nothing to do with CEXs. Yeah. This is stable coins across the entire ecosystem. DEXs everywhere. Yeah.
Yep.
Okay. You can see that it's effectively linear, straight down, with, you know, the occasional, you know, little bump, but this is just heading down. This represents, so, again, fiat directly leaving the entire ecosystem, not just CXs, everything. So, you know, we're off 30, $40 billion, what is it? Yeah, say $35 billion, $40 billion in fiat withdrawn from the ecosystem. And people go, where does it go? And I go, look, $40 billion withdrawn into global liquidity of 50 trillion is untraceable. It doesn't matter. It left.
Right.
It's gone. Yeah. If you were sitting on the sidelines, the friction to get in and out, and trust me, there's significant friction and ever increasing friction, thank you, Choke Point 2.0, to get in and out. If you intended to play this game in the near term, you would not be exiting. So again, just to say that, you know, everything here flows through back to global liquidity, through to VC deals, through to balance sheet holdings, through to trading volumes, institutional trading volumes, through to fiat leaving. Okay, it's an entirely consistent picture. Okay,
Shaun, quick question, Shaun, just on this point. When I looked at this chart earlier, I thought it was just BUSD. I didn't have my glasses or something. And so I had all these interesting points about when people were selling, you know, the BUSD burn down and when they were moving into USDT and things. But now that you said that's all stables, I'm like, I find it really interesting that it's reducing like that. But at the same time, the price of BTC is going up.
Again,
or what?
Yeah, and maybe it still will. Again, you know, you've got to separate, in my mind, trader games. So in the same way, you go like, why is price going down here? And we added $30 billion of liquidity from the top. Yeah.
Yeah.
Right.
Things are these things, operate not in direct, they're not completely in sync. In fact, they can be 6-12 months out of sync. So this is not a question of, is Bitcoin or crypto going to go up, up or down today or tomorrow? What it tells you, though, is a larger context of direction.
Right.
Yeah. So if money is leaving, okay, that's just bearish. It just is. And 30, 40, 50 billion, whatever the hell ends up leaving in the end, okay, disappearing into a $50 trillion hole, doesn't matter. But what people should understand is that the friction to get back in is significant. So this is a decision. And I think that if you look at the decisions of people like Jump and a couple of the other institutional market makers, you begin to see that this is a repeated pattern.
Can I ask just a thought, Shaun? When you see that stablecoin, I guess, volume on exchanges or overall stablecoin, like total holdings is going down like that, and you see the Bitcoin price going up, do you ever think that maybe some of those have been, converting into Bitcoin, and maybe that drove the price up in the first quarter or contributed to it?
Okay, so you can't buy a Bitcoin without a stable. Let's say, okay, we'll look at the fiat later.
Right.
Okay, but the stable still exists. Okay, so the stable isn't destroyed. It's like I say to you, Joe, listen, I'll sell you a token for $10. I give you the token. You give me the $10. Okay. Both of these still exist. We've just traded them.
Right.
Okay. This is the destruction of stables, which means that I've taken my $10, okay, of stables. I've gone and redeemed it for fiat. I have left. So, the process of trading doesn't destroy the stables or the token. It simply changes the ownership. So it's not this concept that if I buy Bitcoin for a stable, my stable disappears. No, just the ownership disappears. For the stable supply to reduce, I have to go and redeem it for fiat. And the redemption for fiat is what matters, because that means that it's leaving. Again, if this is on a DEX, a CEX, in the toilet of your local pub, it doesn't matter. This is the existence of stables throughout the entire ecosystem. And it is a very good proxy for everything, because while there's still some fiat trade going on, it's actually declining.
Yeah.
Okay. So again, to explain this, the only way that stable supply reduces is redemption to fiat. And that trade itself doesn't get rid of anything. It just changes who owns it.
But yet still the total pool of stable coins is going down dramatically.
Which means as this goes down, that means it's being redeemed for fiat and it's gone. It's out of the ecosystem. Yeah. As this goes up, it means that people are sending fiat that's getting put into the ecosystem. So this is a very simple, if slightly misunderstood thing. This goes down means fiat's leaving. This goes up means fiat's coming in. Really, that's it.
Yeah. So when I go to
everything here is completely coherent. There's every single way you look at the market, you get exactly the same story. Yeah.
Yeah. No, I agree. I was thinking about, like, when I offer up through Coinbase, and so I usually move in, like, say, Circle or USDC, and then I swap it to USD, and then I move it off to the bank. Does that Circle, that USDC, when I swap to USD, actual USD on Coinbase, does that Circle get destroyed?
Well, what will happen on a CEX is that for kind of retail size trades is that they will keep afloat. Okay. And ultimately, if there's enough withdrawals, they'll go and redeem it from Circle. Yeah.
Got it. Okay.
So it may not be happening at the moment that you're doing it, that's destroyed, that they're going to keep afloat. But ultimately, if they're, we've $500 million of withdrawals because USDC, then they'll go and redeem the 500 million from Circle, or from Tether or from Meta.
Yeah. I'm not quite at that level.
Me either. but you see what I mean. So it's not
Yeah.
that, every time one of us normies is doing a withdrawal that it's reduced. There's buffers and balances and so on. But I mean, in my little trading business, we would do redemptions directly from Tether. So we would send them Tether. That Tether is burnt, okay,
Yep.
and the fiat ends up in our bank account. That's how it works.
That's interesting. A lot of people don't understand that.
Yeah, and again, that's why I'm trying to, because I'm sure everybody is bored to listening to all of this. I said, I'll try it one last time and I'll post the data. And again, if people are interested, I'll try to answer the questions. And again, there's things that I see Niblets there going, the where the money goes is important. And I'm going, look, I'm not interested in theories in this business. Yeah. That there is literally no way to know where it goes, because inside our ecosystem, it's a blockchain. We can measure it. Once it goes out into fiat land, God knows, yeah?
Yeah.
And it's so small, we're such a tiny, again, 50 billion, 35 billion, 40 billion into 50 trillion, forget about it. No,
Drop in the bucket. Yeah.
Yeah. Okay.
So again, I'm just looking at our space, and again, to this thing with Niblets, I could have loads of theories of where it goes, but it doesn't matter where it goes with respect to what's happening to our ecosystem. The point is that as you suck fiat out, eventually the balloon deflates.
But yeah, and also the one point even that I was missing, I'm sure a lot of people probably were as well, is that what we're really saying here is this is the SEXs and I guess the DEXs going in and dumping huge quantities of stable coins back to the issuers for fiat. Yeah, okay. That's the big thing I was thinking in.
Dude, hands up, the dyslexic drunk Irish guy is probably not the best guy to explain this shit. Okay, so
you're doing great, though,
you do
dude.
great explaining shit.
Yeah.
So just to say that, then okay, let's look at this regionally, yeah. And this, like, I've such a bug up my ass about crypto media and CT in general, because what this does is break down spot trading volume, which is really important, because spot trading volume is how money comes in and out, and it looks uniform. Yeah, the fact that this is 2 billion and this is 32 billion should reflect something here. Okay. Okay, so again, this is a complete distortion of reality in many ways, but it's interesting. So what we can see is that Japan has been expressing an interest in spot Bitcoin.
Yeah.
Nice.
Okay, and you can go down through there to an additional 2 billion. You got whoopee-doo, Japan's interested, and that shouldn't be a surprise. Yeah. Unfortunately, America is disinterested to the level of 32 billion, net counts.
Yeah.
That's interesting.
Yeah. So again, this thing where we did see, money supply grow in Asia for I think December and January, we shouldn't be surprised to see this. But again, this graph is slightly disingenuous in that it doesn't really give the scale of the fact.
Yeah, I was going to say that scale is so fucked up.
Yeah, I mean, they're doing a percentage. We've had a 60% increase in Japanese spot trading volume, but it's 60% of fuck all, and we've had a 60% decline of a very large number. Okay?
Yeah, exactly.
Good point.
Yeah, this is one of those charts,
tricky ones
that distorts the actual data.
What's interesting though is I do like seeing, regardless of the skewing of the visualization, which is one of those things I hate too, when you see these huge drop-offs. It's like, oh, look what's happening to price, and you like zoom in and you're like, that's like 10 cents. It's just they spread the chart apart, But I love seeing Japan back in the game, and I've had a couple of good conversations the last month with Japanese investors and friends of mine, and younger guys don't remember, but when they were the juggernaut in the late 80s, the Japanese economy was the one booming, leading the world, and that bubble popped, and they've been in a deflationary cycle for 30 years. and now they just came out of it. And so with that yen maneuver, so now they got positive interest rates. They're back into like inflation economy, low one, not not deflation anymore. And and now they're buying Bitcoin, and now they're like moving crypto to forward on regulatory positions. Where before, Brad, you and I talked about this a lot. It was very much not acceptable. Maybe 2 years ago in Tokyo. Now it seems like it's going to be government policy, so that could be a huge impetus. Coming forward in demand, because they play a strategic long game too.
Absolutely.
In a different way than the Chinese.
I would also say that Japanese volume represents a lot of the Asian interest. A lot of Chinese traders will be trading through Singaporean or Japanese things. But again,
Good point.
You can see it in the global liquidity, okay, and you can see it flow down. That there has been an interest in Asia, but that interest is so small. Again, everything's about net, relative to the complete, flight from the space here in the Western world, and primarily in the US. Which again, look, we can see, the data is coherent, but you can also see it in Operation Choke Point 2.0, the regulatory stuff. So you have a macro context and you have a regulatory context, and everything is coherent. Let's move on. Now,
wait, could you just expand, Shaun? Real quick, I kind of lost that. When you say that regulatory experience and macro experience are correlating or concurrent, just summarize that for me real quick. What your thoughts were there?
So what I mean is that when we just look at global money supply, for the first chart, we can see that flow through every aspect of the money supply in our ecosystem, from balance sheet holdings through to this, that, and the other. Okay. But we also did see a little pop up, which is ended, just to be clear, in Asian money supply that is reflected in Asian interest. As in we that. So I'm saying everything is coherent. Yeah.
Right.
Where we see money supply pop up in one part of the world, we see interest in Bitcoin pop up. And again, that's really positive. I'm not saying that, but I'm just going, we need to look at this net. The net is still horrendous.
Yeah, but your point is absolutely right, that further proof that when additional capital comes into money supply, in whatever way it happens, stimulus or printing or anything, some would argue that's the same thing, but I just mean more like correlated stimulus, then people buy. So it really shows that it's still risk on asset.
Money needs to find a home. It's that
simple. That's cool. That's good, man.
The more money it is, the bigger home it needs. So I mean, you think like that. But my point is that this is a coherent picture. It's not a nice. I mean, there are nuggets of really good shit, but unfortunately, they're buried in a pile of cow manure. So you have to kind of dig through that. If we look then at things that CEX stuff, okay, so. This picture tells its own story. And again, here, what this really reflects is institutional market makers going, I am the fuck out of here. Okay, so we have the news, of jump and start, whatever the hell they're called, going, we'll take our dollars and leave, and we can see it in the data. And this is just the depth of the bid and ask. Okay, they're gone.
Is that I can't say I'm on the phone, but is that actually the same deviation away from the price, like going left and right? I mean, is that the same pricing? God dang, that's insane.
That's really freaking stark.
So
I had no clue of that.
And again, like everything flows coherently through. You can track this all the way down through the ecosystem. Again, I did this last time, and I'm going, what does liquidity look? So this is Bitcoin price. Okay, the dots, the brighter the dot, the more liquidity there is on the books. This is what the bottom of a market looks like. People flooding in with liquidity, and guess the news, once they accumulate, off to the moon. Okay, so again, just another example of you know, this thing flowing down all the way to an order book on some bloody exchange, yeah?
Yeah.
And finally, just for Joe, the when. The when is completely unanswerable, okay? Because it just it just is. Yeah, I mean, it's not the way, you know, it's not the way the game's played. So, but this is worth looking at. Blue, Fed interest rates. Okay, black is, I think it's the S&P. Red and green, M1, M2. Ignore those for the minute. Okay, the green zone here is the time in which Bitcoin has existed, i.e., the time in which crypto has existed. Okay. So what's really important if we're to be rational about the market is to understand that our asset class has existed only in a QE environment, okay, only in a number go up environment, okay, up till late last year, or late, Jesus, the year before. My God, it's getting so long, okay? We are untested in a bear market. And I think that everybody understands that we're highly correlated still to TradFi and so on and so on. So what we don't know is what's going to happen when, you know, when TradFi finds a bottom, or, you know, and so on. But again, using history as a guide, and history never repeats exactly, but in some ways it's a useful guide. The when is kind of concerning because it's actually very simple. If you look at these orange lines represent Fed cuts. So what happens is the Fed pumps up interest rates, pauses, cuts. Yeah. Okay. You can see we're still in the up. I think there's a reasonable expectation of a pause or whatever. Yeah. And you can see during a pause, you get a little relief rally. But as soon as the Fed cuts, it tends to actually be the start of the major market downturn. And the bottom of the market will tend to be 1.5, 2 years away from the first Fed cut. So and this is where we're into projection rather than hard data, yeah? So if we believe that history is going to be a guide, then what we should be doing is really setting our clock on the first Fed rate cut and giving it 1.5 to 2 years to find a bottom.
Yeah, when I look at this, I think I actually remember a lot of horrible stories when I look back at .com and Great Recession right there, a lot of wealth implosion personally. But, when I look at back at like .com and like you said, when the rate cut happens, that's the beginning of the end, so to speak. It's because when these markets are booming, in the U.S. in particular, I'm talking about, it is so hard to shut that down in the sense, even if everybody's going, it's a bubble. Nobody wants to do it politically because it's just committing suicide, basically. So they hold on as long as they can, and there's this big debate. And then when finally they decide to do it, then everybody's like, the hikes. Then everybody's like, oh shit, it is overheated. And then they all start dumping. And that's when the market starts contracting. But this one is kind of weird with the pandemic and just a tremendous amount of stimulus that was put out there. Yeah. Where I think it might be faster is one thing I was going to say. But also, I'm kind of curious, Shaun, just one thing. The taper tantrum, that little hump in 18 during crypto. Now, that was when they were trying to raise rates, but the same thing was happening coming into an election cycle. And the White House was like, no, stop that, basically. And everybody was panicking, and they, started cutting again or stopped the raising. And then that led right into the pandemic, if I'm not mistaken. But I'm wondering how you think that looked at price. But then second, do you think we could just be in these like steeper curves both ways? So maybe it's not 2 years, maybe it's, 3 months.
I mean, I think everything accelerates. I mean, we there's also what's really obvious in the chart is that even when the Fed come to cut rates, which they will always do whenever they do it, this is the first time we have actual money supply decreasing as well. Okay, so we've got this double unknown effect of going, like, you can see, when they were cutting rates, money supply was still increasing. Red is M2. Yeah. Okay.
Yeah.
Now we have money supply decreasing, and you can see that that's already having an effect on the market. Okay. And yet we have yet to see the effect of what happens when we pause. And again, you get these pause. You can see when they start to pause, assets go up, and blah blah blah. But it's unknown. I think everything is faster. So I'm not. This is again the question of when is more a question of how you. For somebody like me, I'm interested in the bottom being based on looking at accumulation and liquidity. Okay.
Right.
So I don't know when the liquidity comes back into our market. Okay. And I'll look for sign of accumulation, but all I see is distribution and so on and so on. And what I also have to be mentally prepared for is history and go, look, there's a non-zero chance that this can go on for another 2.5 years. Okay. And that sucks. But, I'm not saying it will, but I'm saying like to exclude that as a possibility is to exclude history. Yeah.
Sure.
Yeah. One really interesting point, Shaun, that you just made that really resonated with me is that even in an upward interest rate environment, when you look at like the 99, 2000 stuff, and you look at, I guess that's 06, 07, but money supply was still growing, even as rates were going up.
Yeah, and assets were still going up back here. You can see that as this is happening, what we're really seeing here is the first effect of liquidity being withdrawn from the market, which again, if you go back to the first slide and follow it through, and it would seem that's a far harsher effect on risk assets than simple interest rates. So in other words, and again, it's not difficult to understand because, the less money in circulation, the less it can inflate the balloon. So what we've seen here is again, if you look historically, as interest rates are going up, okay, the market's still going up. Yeah. Liquidity is still going up. So you would say that liquidity is actually would seem to be, and I think you can make a very strong case that global liquidity is more impactful in terms of pricing of assets than the cost of money. Now, obviously, global liquidity and the cost of money matters, but what's clear is that global liquidity counts.
Yeah. Well, the other thing I'm just thinking now, in those other earlier ones, there was no Fed balance sheet issue. Okay, so Fed balance sheet back then was like, I still think less than $1 trillion back in the dot-com days, and now I don't even know where it is right now. Is it 8, 7 trillion, something like that? So that money has been winding off the balance sheet, and that money comes directly out of the bank's Fed accounts across the board. So that directly sucks liquidity out, but also removes it from the future lending. So the 11-to-1 lending ratio or lending multiplier on $1 at the bank, that goes away too. So it would have a very dramatic impact on, actually M1 or money supply and issues like that in this correction or this, cool down. So that might be the big difference, is that balance sheet and what it's doing to liquidity, because that would be the only thing that makes an explanation for all this M1 coming out now.
I mean, the other thing to consider as well is to stop just looking at US liquidity. We need to look at global liquidity.
Yeah.
Because we can see the impact of, this is a global asset class. It's traded globally, on DEXs, on SEXs, all around the world. And in many ways, the US is even though the US money has a disproportionate impact, it's also the most difficult in and out because of your regulation stuff. Yeah, but you can also see the changes in global liquidity have impact in our space. So this when thing is again, you can look at the data. The data is the data. It's just data. You can decide to view it one way or the other. Okay, for me, it's very coherent all the way through that we're seeing the same impact. Once you start to talk about, whens and so on, then, I suggest that people start thinking of looking at, well, what do bottoms look like? What do I expect the bottom to look like? How do I measure it? How do I get an early sign? And, maybe that's the time to scale in. And again, not financial advice, but I was just trying to, the drunk Irish dyslexic guy who doesn't explain himself very well, maybe give it one more shot.
Mm-hmm.
I think you've done a beautiful job.
Yeah, exactly. No, it's always, well, these are always evolving too. This is not like a simple concept. It's not binary, yay, nay. It's like, a, I don't know, 1,000 by 1,000 point matrix basically, and trying to figure out where the answer is. I mean, this is very complex stuff. So you've done a great job.
Yeah,
Thank you.
Beautiful. All right. So did you have any more data you wanted us to look at?
No, that was it. I think I'm being depressing enough for the week.
Well, you were going to talk about how to make money.
Yes. So, there are ways to extract value in this game that have nothing to do with the absolute price or the direction of price. Okay. And so we went through the market making stuff, which I get. People think is complex. It's really not complex. It's just a bit of hard work. Yeah, a bit of math. Yeah. Okay. But the old go-to in the crypto game, if you just want to print dollars for no risk, is what's called the basis trade or the cash and carry trade. Okay. And how this works is you've got two key instruments in the market. You've got the spot price, which in this case is red. This is Bitcoin. Yeah. And you have the futures price. Now, futures, not perp. Okay. So these are time expired futures. So if you think about how a futures contract works, you go in, you take a position, long, short, and that it will always expire to the spot price. Yeah, it's settled at the spot price on the day of closure. Yeah.
Mm-hmm.
Right. So any differential between the futures price and the spot price is free money. So in the case of, and futures are either in contango, which is where we are now, which is where the futures price is higher than the spot, or backwardization, where the futures price is lower than the spot. And all that you do is you long the red, you short the whatever fucking color that is, cyan. Okay. And 100% that on expire these converge. Huh. And what you do there is you just walk away with the premium. Okay.
That's beautiful.
Yeah, I mean, this was the, I mean, in the good old days, you could make 70-80% a year out of playing this game. Okay. And it's the simplest of trade. I will put a video into the group that explains it far better than I will on the mechanisms of it and some of the things. But the only risk that you carry on this, you have no price risk. Okay. The only risk that you carry on this is counterparty risk. Who's your counterparty, which
right.
Is a risk in the space. But again, there's lots and lots of ways to extract value from this system, okay, that are nothing to do with market conditions, nothing to do with price direction, and are relatively risk-free. In this case, 100% risk-free except for counterparty risk. Okay, so there's no trade risk, there's no price risk, there's nothing. So there are lots of ways that you can extract value from this game, and even whatever your view on the market is, and you go, look, I'm just a miserable maxi fucker who thinks the world's going to end. That's fine, yeah. But even, and you could be right. Nobody knows the future. I can only look at the hard data as it is and draw my own conclusions. But there are still ways to extract money from this system if I'm right and if I'm wrong. Yeah.
Right.
And again, market making is certainly one of them. And the other one that I was going to bring up this week was to go, look, the old basis trade, the old cash and carry trade, it's just so fucking reliable. It's just a great way to make money. That's
beautiful. I love that. Love that. And you said you'll put something in the community about this.
Yeah, I'll post a video of it that explains. And again, I'm always around in my maxi grumpiness to explain any of this stuff, including the graphs and so on. But you know,
And,
if the worst happens, and again, I can't rule it out. I'm not saying it's the high probability case, but you know, there is a non-zero chance that we're just going to grind down and sideways for 2.5 years. I mean, anybody who rules that out, I think, is being naive.
I totally agree.
They don't need to make it their base case for sure, but you know, to exclude it completely, I think is I don't think you're being fair to yourself, or and so on. But you know, regardless of that, there is still lots and lots, and you know, maybe next week I'll give you another couple of these old things where there's so much free money out there, you know, and you know, this is, you know, I get it. The market making may seem complex. It's truly not complex. It's a bit dumbass. This stuff is just, you know, you make one trade a month. You express the difference in price. You know, rinse and repeat. Simple.
That's beautiful. And look, two things. First, I'd rather bet on people like you and others in the market who are saying similar things and data. So experience, success, data, than I would bet on hopium. And I don't see any true data going the other direction, right? So it's very difficult for me to see anything but what I'm seeing over and over and over again from people like you that I respect and trust. So that to me is a decision-making point. And if I can confirm data, then it makes me feel better about it, right?
Well, it's the old world in this. You know, nobody should just take anything that a random fucker like me says on the internet. I don't, yeah. You know, DYOR, don't trust, verify. Okay. Yeah. And these adages can make you and save you a lot of money over the years. Okay. What I'm trying to do is simply to say to people, like, I'm not shilling any bags. I'm not looking for anybody to do anything. I'm expressing a view in the market. Again, always happy to be wrong. Okay. But I do think that it's something that people can research themselves. It's not difficult. Yeah. And they can draw their own conclusions, and that I'm incredibly hacked off with the crypto space over narratives and how damaging they are to people. Yeah, I mean, like, this costs real people real money, and can destroy people. You know, and I look at this BitBoy fuckology, and I'm going like, you know, if my horseshit that I produce here can hopefully help somebody on a path to financial freedom, just one person, I'm fucking happy out, yeah.
Heck yeah.
That's beautiful. Love it.
Well, you know, you bring up a good point, Shaun, is that, you know, when we talk about some of these other promoter types, let's say, where you have a big personality around a protocol, let's say, or BitBoy and his audience, you know, you really see that it's preying on people that have a need or are in desperate straits, I guess. It's sort of a lottery ticket marketing. You know, it's like, you're probably not going to win, but you're selling the dream, and people want to buy that dream. And to me, it has to get beyond the emotional. You know, that you have to do it in ways that, you know, if you're going to market, you have to market in ways that aren't just trying to bring in all the, you know, selling hucksterism or something. It just seems it has to be real, and it will get there eventually. But, you know, to your point, when we put this kind of data out, it allows people to make better decisions. It allows people to think about it more professionally.
I would say about it is that people put in a bit of hard work, and I'm not talking about, you know, going on to per contract and clicking long and short, and because, again, I'm very much of the view 99% of people shouldn't do that. I'm just saying that there are ways that you can extract value from this space. Okay. And you know, they're not the 1,000x lotto ticket dream. Yeah. But you do that long enough, and trust me, your life is going to be wealthier and hopefully happier if wealth is something that makes you happy. So, you know, that's look, and again, these are just my opinions. I could be like, the data is the data. Okay. Like, and I'm giving you my view. The data is coherent and flows all the way down through the value chain in the crypto sphere. Somebody else can draw their own conclusions. I'm just saying to people, for their benefit, okay, think about it. Yeah, just
here's another opinion. Here's an opinion, basically. Yeah.
Yeah.
Totally cool.
And look, other methodologies for earning money in a market like this next week would be great, Shaun. I think we would all love that. So that's great. And I was going to say, related to the, by the way, if you aren't in our Telegram, you're missing out on the opportunity to ask questions of Shaun and others. You're missing out on the opportunity to get other information and data. Join it now, t.me/mission DeFi, t.me/mission DeFi. That's a Telegram channel with multiple channels within it of different topics, including Bitcoin and others. I think that I think that folks on the market making side of things don't quite get kind of the base kind of algorithmic stuff that you're doing. And obviously successful money market makers are not going to share their algos. But I'm wondering if there's like an example of one that's like no longer functions, or that used to be one everyone used, or whatever, that we could maybe talk about in the community at some point.
Yeah, no. Look, I mean, I was probably a bit abrupt because, I and also I have some direct experience. Like I became the #1 market maker in terms of trading volume on the poxy little CEX. Now, that's nothing to do with me improving my market makers. It's to do with everybody of significance leaving. Okay, so I can see this in real time. I can see the stuff that in these charts happening in actual reality, and so on. But yeah, well, look, it's a highly competitive game. It does require 2 skills: maths and coding. Yeah. And maths is the #1 skill, and the coding, just ask ChatGPT. Like, I'm fucking embarrassed. I spent all these years, struggling with WebSockets and all kinds of bizarre things I don't really understand. Whereas some kid can now just go, here, give me a WebSocket for Binance, and it does it.
What do you think? What do you think Brad's talking about here, Shaun?
So I don't want to not help, but I'm also, why don't market makers share algorithms? Is because there's a limited amount of liquidity we're all competing for. And if somebody else is using your method, they're literally taking money off your table. Yeah.
Exactly. No, totally makes sense.
Okay. I also have to eat.
Sure.
But yeah, no, I have no issue with that.
And that pub check's not going to pay itself.
Yeah, hey, dude, that bar tab needs to be dealt with at some time in my life.
Mr. McDade's pulling out the bully bat about now, looking at you, right?
The other thing that I suggested, since I'm sure everybody is like sick of listening to me do this, is that over the years I have worked one-on-one with a few traders who've become friends. And again, to be clear, I don't charge for it. It's just fucking people who for some reason we became friends, and I've kind of tried to help out. And a lot of them started as full-on degen shitcoiners. Excuse you, it's a term of endearment. And their story is interesting. So I was going to suggest if I could bring one of these friends on with me next week.
Yes, of course.
And we can discuss their class of 2020. Holder of 150 shitcoins, made some money. And maybe always good to hear about somebody who has lived through this, and you may not agree with their perspective. You probably don't, you don't need to, but it's always interesting to get views of these people. So his friend of mine.
Are you thinking of a more recent one that we both know?
This will be anonymous, this person.
Okay.
We probably both know her though, Brad.
Yes, yes, absolutely. I think that's probably a really powerful story.
I think it's and it's a success story, by the way.
No, totally. Love that.
Zero to hero. And I just think it's really good content for anybody playing the game. To listen to a success story, and the highs and the lows and the lessons, and because we can all let the market beat us up independently, and it wants to do it. It wants to strip the skin from your back. But maybe maybe listen to those people who've already had their back flayed and try not to go through the same.
Yep, totally agree, buddy. That's fantastic. That's awesome. Hey, another thing, Shaun shared an awesome video from Trader Sumo and the Telegram group. I am, after I say goodbye to everybody, going to let that live stream here. So those of you listening on the podcast can listen to it, but I am going to suggest, if you haven't joined the Telegram, join it, t.me/mission DeFi. But I'm also going to put in the show notes a direct link to Trader Sumo's video, because he was kind enough to say, yes, it's cool to share. But he also may join us for an interview at some point along the way here, because
Oh, cool.
it sounds like he's really got his shit together and has some.
Yeah, I mean, I don't like to shill. Most of the trading stuff you see on CT is utter nonsense. And over the years, I think Sumo's method of trading and the way he looks at markets is just so worth listening to. He does an expensive trading course, and again, I'm not shilling him. I wouldn't agree with Sumo on 90% of stuff. So this is not bro love. I've never spoken to him, but I think it's literally, if you want to be a trader, which is very different than everything else we've discussed, it's worth considering signing up to what he does.
Awesome. Yeah. Well, and I love his tagline, "World's most hated trader." That's
it's
great marketing. Shaun, awesome content today and awesome lessons for everybody. Really appreciate it. So thank you again for joining us. Niblet, Shizzy, and Chuck, thank you so much for comments and questions here. It always helps move the conversation along. And I will we'll see everybody next Monday. If you're listening now, feel free to stay around, because I'm going to let this video from Trader Sumo play, and I'm going to link to his Twitter profile so you can go follow him, which you probably should do. And as always, you should also probably follow Shaun, XBT3D, but I think he gives most of his good stuff in Telegram. But
don't follow me on Twitter. There's no point.
Yeah.
No, you follow you and then click on the replies tab, because you give a lot of good stuff in the replies to people. So, and appreciate everybody joining us. Thank you very much. If you're listening on Apple Podcasts or Spotify, please rate and review us. It really helps boost the show. And if you're on YouTube, please click the little bell if you've already subscribed to us, so you get notified when a new episode comes out, and make sure you smash the thumbs up. That'll make Joe happy. So thank you very much, Joe. I'll see you tomorrow at Bitcoin Miami, and
absolutely,
Shaun, and we'll have some updates from there probably next week, I guess. And Shaun, I hope you have a great weekend, and thank you again.
And anybody who's around Dublin, you could see me in Bitcoin McDade's.
There you go. I love it. I love it.
I'm willing to line up for that. That's the kind of like Lollapalooza this summer, right? This is going to be doing circles around the bar. All right.
Exactly.
Talk to you guys later. Thanks, everyone. Thanks, Shaun.
Take care.
Thanks, Brad.
Thanks, Shaun.
Bye, everyone. Cool.
Bye.
You're going to run that now?
Yep. Hold on.
All right. I'm going to split, dude, because I got to go track a meeting. Are we still live? Oh, we're live. Okay.
Yeah, we're live.
Yeah, I got to go find some meetings down. So I will catch up with you later on today. All right, buddy?
All right, buddy. Have a good day.
Talk to you later. Bye.
Thanks.
So I see all kinds of trading styles and methods, and they're using specific days, and they're trying to like basically form a model or a pattern-based type system. And when you get price action like this, where it's congested and you don't understand trend, which basically almost none of you do, you get destroyed, or it's very easy to get chopped up, because you're thinking more long biased in time, meaning you're thinking more about swing trades than you are what's actually happening. And admittedly, these are tricky places to trade. So what I'm going to do is just look at the chart. I'm going to show you some ideas, some things that are happening in the price action that you may not be readily aware of, but I think that you should be. And we should just kind of leave it at that. All right, so when we go to the daily real quick, all I'm doing is just marking these blue lines are weekly levels. And I wanted to mark, there was a daily from way back here, I believe, that we got pretty close to. Yep, right here at the lows today. Change that color. Okay. So we have to think about what is happening in the big picture here. Okay. Big picture, weekly chart, losing support, losing support. Basically, here's your trend to your high, losing support a couple weeks ago. We bounce, come back, retest, and sell off. And I think there's actually a level here to the left. Here, yes, the start down in containment, which is why when they go through, they lose support and come right back and test it and fail again. So you're getting this downtrend satisfaction. Okay, so they're losing support, which is exactly what you see them come back and test today. So two things happened. You come down, test a daily, which almost none of you understand as a daily because you don't know how to define trend and you're not looking in this area properly, which is fine. But they come down and test that daily, bounce, and then they come right back and test the weekly support that was lost. And so now we have this inside weekly candle that is forming as a result, where they're trying to lose support on a daily and a weekly, and they're not doing either. So why is this happening? Well, there's a momentum change. They're trying to shift the momentum. Does it mean that, say, Friday when FOMC comes out, that we can't lose it? No, we absolutely could. Does it mean that on Friday we can't gain it? No, we absolutely could. So, that's why it gets tricky. But there are some expectations that you should have when you start seeing price behave in certain ways. Like, for example, we're looking at this kind of a mess where a lot of people would say, oh, this is consolidation. It's whatever you want to call it, right? And that's fine. But I want you to think about the process of what is happening. So we have a trend up here, which is in containment. We have a downtrend in containment. So what is happening? You're basically creating a new downtrend. This wick we know is testing the weekly, but there's also a daily here. So they basically get two birds with one stone. And we come back down on first test, which is exactly what you would expect to see in most cases. Now, it doesn't always happen, but it typically that's what happens. First test gets rejected, and so you have to ask yourself, well, what just happened? There's a trend up here, so let's color this maybe with something really obvious that you can see as an uptrend. Well, that's creating support in the market because you created a new trend, you're creating a new support. You didn't gain anything from this move down. This candle here doesn't gain. So the expectation in normal circumstance is you're going to make a new low relative to your current trend. So if I were to just move this to our more immediate trend at that time, would have been this contained trend up, right? If that happens, we know we're expecting a new low simply because we didn't gain. Because the nature of trend, the principle is, if you're moving higher and you don't gain the start down you just came from, what do you have to do? You can only make a new low. Okay, that in principle. Now, sometimes you get reversals and the roles reverse, and then you say, oh, well, we didn't lose, so now we have to go higher. That's just the most basic concept of trend. Doing what you were doing previously. Because if you do not do what you were doing previously, then you were doing something else. You were doing the opposite. Because in trend, you can only go higher or you can only go lower. Very, very basic stuff that almost none of you really have conceptualized and applied to your trading to understand the logic behind why new swing highs and new swing lows are made. It has nothing to do with running stops. It has everything to do with logic, with this principle of trend, the things that you intuitively know, and you don't have to assume. I mean, it's just that simple. It's almost silly to even explain, but so many people aren't aware. Okay, so we make the new low. But now what also happens? Notice we have the daily here. So let's mark that daily because the process of trend creates levels. The levels are dynamic. Trend moves through time and it creates and forms new levels. Well, as you test those levels, they become less significant. You don't need to constantly, the market needs to move, all right? It can't just stay in the same area forever because no one would want to trade it then. Okay, so whatever. So we come down and we notice we make our new low relative to this low. So we establish we make a new trend, which you can see the polytrends algo is drawing here for us, tells us that there's a new trend, and it's in fact it's drawing another one. You just can't see it because it's in one candle, but these dotted lines here are showing you that there's a new trend up. Now you have to remember, you didn't lose support here. If you don't lose support, what did I just say? If you were coming down and you hold and you don't lose support, well, then you have to go make a new high, because that is the principle of trend. That is what you need to do to create a new trend. That is how you satisfy the principle of trend. So they make a new low, but they don't hold, or they don't lose, and they end up holding this daily at 26.8. So what is the expectation? Well, the expectation would be take out this high. Now, does that mean they're going to gain this level and go higher? Not necessarily. But let's look at the 4 hour. Why are we stalling? It's the same principle. Let's move this out of the way and let's think about it and just start breaking it down. We are creating more trend on 4 hour. There's multiple trends, multiple levels. Well, did we not just create a downtrend in this move down? Well, let's look at the 4 hour. Where is the 4 hour level of significance? Let's make this yellow, and we'll say that this area is our 4 hour trend start down. And it's also going to have this level of support there's 2 levels here, creating your trend up to this high. So in the process of testing a weekly, we created more 4 hour trends, time frame, multiple time frame analysis. Okay. So we come up and test it for the first time. We get our first test repulsion. And what do? The very next candle opens up, attempts to gain, doesn't happen, and what? Fails. Well, where do they come down to? They're holding this support. The support you just made to that high on the 4. Does that mean that they're going to hold forever? No. But generally, the idea is if you lose this, you're going to come down and test the next couple of levels down here below. But in turn, that doesn't mean that you can't go higher when that happens. Why? Because in this process of moving down, you actually moved up immediately after, and you gained this level of resistance. So the process, we know that we're holding a daily. We're creating this big double bottom. That's the process of accumulation. All chart patterns are either accumulation or distribution. Many of you have improperly learned those definitions. You think they mean something else. You're attributing them to accumulating longs and accumulating shorts, and that's simply just not the case. Accumulation and distribution can be multiple things. It can be people getting in positions or getting out of positions. It is a entire process. So you've been taught improperly. And the thing is, it's kind of silly because it's been a accepted concept for around 100 years. You're just not aware, but whatever. So the idea is, because we're holding this level of support, then the idea is we expect to make a new high. Now, that doesn't mean that the market will do that. That is just the logical expectation. The market can do whatever it ends up doing, and we change our expectation if we're proven wrong. So keep that in mind. I want you to understand why this area is chopping around the way it is. It has nothing to do with trying to find liquidity or trying to find buy stops and sell stops. It has everything to do with the structure of trend and all of the levels in play right now that are in your way that you're not seeing. Okay. Like, for example, this low is essentially testing that daily level of support from way back in early 2021 that almost no one that you know is going to even point out to you. This level here. Why is it important? Because it makes a downtrend, makes an uptrend. And we go and look in our current action. Well, guess what? Price hasn't ever lost it. So it's still in play. We've never lost it yet. Since we gained it here. We had all of this distribution playing out, this sideways action as we're trying to sell off. We never lost it. So guess what? It is still an important daily level of support. It's really that simple. You don't have to overcomplicate it. I know it might look complicated because there's a lot going on, and the more you learn, the easier it gets, okay? So keep that in mind. We're trying, in theory, to make a new swing high here. But keep in mind, we have to gain this weekly that we just lost. And typically, when you just lose a higher time frame level of support, you can make the new high and then dump. So don't get super excited. Tomorrow is a big day. I would be surprised if you got your new high and potentially a new low all in one day in FOMC with Jerome Powell speaking. So just, if you're not really good at this stuff, it's okay to take your time and just sit back and watch. All right. There's no reason to blow up your accounts because you're getting chopped up in, say, a 1,000 point range and you're over leveraging. Okay. All right. You guys have a good one. I hope this helps.